While growth is enviable right now, but the deposit growth is something which is, I won't say pathetic, but it is slightly poor. The gap between deposit growth and the credit growth, I guess, is the highest in last 10 years. Do you see that gap narrowing down, which means growth has to come down or deposits have to go up?
Well, it is narrowing down. You've already seen the credit growth come down a little bit in the last couple of quarters. We are predicting the credit growth to be in the 13 to 14% range next year. The deposit growth is obviously muted. This is not sustainable in the long run, that you have a jaw which is negative. The deposit growth should be slightly higher than the credit growth. So at some stage it has to turn. Hopefully some of the changes that are happening in the budget will support the deposit growth in the banking system. Our view is, and as you would see, while the bulk deposit rates had caught up with the increasing interest rates earlier, even the retail deposit rates, if you look at the retail deposit rates today, they've already reached the peak of the last cycle. Today, for example, Axis Bank is offering for 1 year 7.26%. The peak of the last cycle was 7.3. We're already there. So I do expect that in the system it might take a couple of quarters to play out, but hopefully people will see value in putting money back into the banking system and the deposits, because some of the alternates might be as expensive or giving the similar returns as what the banking system is giving. And if it does not happen, well, at some stage the credit growth has to be tempered. There are no two ways about it. But all of us are also at the same time ensuring that we are expanding our physical infrastructure. We are spending a lot of money in digitally also, so that we can reach out to more customers. And as that happens, hopefully that will continue to give a fillip to the deposit growth. But right now, deposit growth is a problem in the system, and we do need to solve it. We need to get it back. Otherwise, at some stage, it will hit our ability to increase the credit growth.
So are you rejecting more loans and giving approvals for less loans?
We are very clear that the loan has to come at the right price and the right risk-adjusted return on capital. That's why if you look at Axis Bank's performance, you will see that on the large corporate side, our credit growth was limited because we were not getting the right price. Now, in the last couple of quarters, we've seen the price come back. You will see that our loan growth is also kind of picked up. So we are quite clear that we need to get the right return for the money we are giving out in the marketplace. That does not mean that we don't do fine pricing, but the overall mix has to make sense to us. And we have worked very hard to get our net interest margins from where they were to where we are now. We would like to maintain them in the same zone rather than just in the desire to get growth, giving it away and unnecessarily putting pressure on ourselves. So we have created the right operating leverage. We would like to maintain it.
You did get an advantage in last 2 quarters because of the interest rate cycle. What would be the lever for Axis Bank going forward to maintain and expand margins?
Well, beyond a point, just expanding margins does not make sense. So as we have said, in the long run, we wanted our margins to be around 3.8% and above. We've already reached 4.2% if I take out the one-offs. So we are already above the zone. So I have some margin to play with. And our view is that we will work very hard to ensure that we remain in that same zone.